Okay, let's revise what we did in the previous sessions. So, in the previous sessions, we were doing the detailed part of investment decision after learning the basics. As far as investment decisions were concerned, we used to do it through a series of 4 steps. First, we find out the initial outflow. In initial outflow, we had 2 items. One, there is a capital expenditure, and second, there is a working capital which gets stuck. Step 2 was in between flows. In between flows, what we used to do is we used to find out what are the cash flows the project is going to get throughout the life. We used to calculate it as revenues less costs, PBDT less depreciation, PBT less tax, PAT add depreciation and CFAT, and final step was terminal flow, which included net salvage value and working capital. After computing this, consolidate and calculate NPV was the step we used to follow. This is what we had done in the previous session. Today we are going to get into few more problems. We also learned certain rules of relevance which said that interest cost is to be excluded, dividend is to be excluded. We learnt about step up discount rate. All of this we have seen in the previous session. Today let's get into the next set of questions. Let's start with question 6. The municipal corporation of a city with mass population is planning to construct a flyover that will replace the intersection of 2 busy highways. Average traffic is 10,000 on highway X and 8,000 on highway Y. 70% are private and rest are commercial. The flow of traffic across is controlled by traffic lights. Due to heavy flow, 50% is delayed. Average loss is 1.3 minutes, 1.2 minutes. Cost of time delayed is 80 per hour and 30 per private vehicle. So, in the first para, the question is indicating that there is a there is a highway. The details of the traffic is given in that highway, the intersection of 2 highways. Now, what this municipal corporation is doing is they are planning to construct a flyover. The reason for constructing this is there is a traffic which is getting delayed, and if I am constructing this flyover, maybe I avoid this delay, and if I avoid this delay, there is a time saving because they have value delay. According to them, if you delay, there is a value attached with the delay, 80 for the commercial vehicle and 30 for the private vehicle. This 80 per hour and 30 per hour can be saved. Indirectly, what they are trying to say is, for a private vehicle, it is 80 per hour, and if you are going to waste 1.3 minutes, it's 80 into 1.3 by 60. Some 2-3 rupees per vehicle is the loss. And the traffic is also huge. 10,000 vehicles come in highway X, 8,000 vehicles come in highway Y. Then also they are saying, because of this traffic delay, you will have to stop and start the vehicle. So, when you stop and restart it, there is a value attached to it. They are saying 1.2 rupees for commercial vehicle and 0.8 for private vehicle. Cost of operating traffic lights is 80,000 a year. A policeman is required to be posted, whom we pay this. Also, there are some accidents which happen. 8 fatal accidents and 16 non-fatal accidents have occurred. To eliminate the delay of traffic and the accidents, both will get avoided. There will not be any delay. If there is no delay, there is no start and stop because the vehicle will run smoothly. There is no start and stop, and also there is no accident. But flyover will add some distance. They are saying it will add a quarter of kilometer to the distance of 20%. Policeman will not be required. This flyover will cost 3 crore rupees. The cost of flyover is 3 crore rupees. Incremental operating cost and all is given. Expected economic life is 30 years. You are required to calculate total net benefits, annual cost to the state and benefit cost ratio. Now, the flyover is going to cost 3 crore rupees for this municipal corporation. The benefit of this will not come to the municipal corporation. The benefit of this will come to the users of them, because this 3 crore is the funds which they have collected from users in different form. Now, what we are required to find is how much benefit the users are going to get, what benefits the users are going to get, how much is the annual cost to the state, and what is the benefit cost ratio. These are the 3 terms they have asked. Let's first understand from a user point of view what benefit they are going to get. Working note 1, calculation of benefits to the users. calculation of benefits to the users, calculation of benefits to the users, particulars, calculation of broader column, particulars and calculation would be broader. Amount could be a narrow column. Particulars, calculation, amount. Particulars, calculation, amount. Now, there are going to be 2-3 savings to the users. One, there will not be any delay in traffic now. Second, the start and stop operation which was getting done, that will also get avoided. And third, the accidents will not happen. But from an user point of view, these 3 benefits are there, but he also has to pay something extra now. There is nothing for using the flyover, but distance increases. They are saying distance will add by quarter of kilometer to the 20% of the total traffic, and if distance increases, these guys have to pay 5 rupees per kilometer and 2 rupees for non-commercial vehicle. So there is going to be an extra cost of 5 rupees per kilometer and 2 rupees. So now first, from a user point of view, I will have to see whether there is a benefit at all or not, because though I get those start and stop getting eliminated, delays getting eliminated, but I also need to pay something extra now because of the distance going up. So next point number 1, saving in delays, savings in delays, savings in delays. Okay. Now listen, highway X. Now how saving and delay will work in highway X is, keep listen for some time. How many vehicles are there? I'll ask you, you can keep telling me. How many vehicles are there in highway X? How much? 10,000 vehicles are there in highway X. 10,000 vehicles are there in highway X into 10,000 vehicles are there in highway X. 50% of the traffic will get delayed. 50% of the traffic will get delayed. There is going to be a delay of 50% of the traffic. What is the average delay in highway X? 1.3. So overall, in a single day, the amount of delay is 5,000 vehicles into 1.3 minutes. This is the amount of delay in a single day. 5,000 vehicles into 1.3 minute, which is 6,500 minutes get wasted. Broadly 110 hours is wasted in a single day. 110 hours is wasted in a single day. 10,000 vehicles into 50% into 1.3. Now listen, whenever there is a delay happens, the cost is not same for a private vehicle and not for a commercial vehicle. So what they have indicated in the question is cost is 80 per kilometer for commercial and 30 per kilometer for private. 80 per kilometer for commercial and 30 per kilometer for private. Now how we can interpret this finally is, there is a composition given. The composition says 70% of the vehicles are private and rest are commercial vehicles. 70% of the vehicles are private and rest are commercial vehicle. Now ignore this 80 and 30. If I have to write a single number, that number is 80 rupees into 30% plus 30 rupees into 70%. This is technically called as weighted average. I can do source, cost, weight, product. Commercial vehicle 80 rupees delay, 30% weight. Private vehicle 30 rupees delay, 70% weight. So on an average 45 rupees per hour is the cost. If I am going to delay, whenever there is a delay happens, the cost of the delay is not 80 rupees per hour or 30 rupees per hour, it's 45 rupees per hour. Any doubts on that 45 number? How 45 came is 80 per hour for commercial vehicle. The composition of the commercial vehicle is 30% and 30 per hour for private vehicle. The composition of that is 70%. 80 into 30% plus 30 into 70%. 80 into 30% plus 30 into 70%. If you add this together, 80 into 30% plus 30 into 70%, you will end up getting 45. Any doubts on this? Any doubts on this? Now listen. So 10,000 vehicles, 50% is getting delayed. 1.3 minutes is the delay. I am converting this into hours by dividing it by 60. I have converted this into hours into 45 rupees per hour is the cost into 365 days. This is what I will end up saving. 10,000 vehicles into 50% of the traffic into 1.3 minutes divide by 60. Why we are dividing by 60 is to convert into hours. 1.3 divide by 60 into 45. How did that 45 come? 80% of 30% of 80 rupees and 70% of 30 rupees into 365. Any doubts on this? Any doubts on this? When I do highway wise same calculation, it's 8,000 vehicles into 50% into, I think the time delay there is different, into 1.2 minutes divided by 60 into 45 remains the same because the composition remains the same, into 365 remains the same. Now write this highway X. You can put an asterisk mark for 45 and show calculation if you want, or if you are clear you can end up writing this directly. 10,000 into 50% into 1.3 by 60 into 45 into 365. $10,000 vehicles into 50% into 1.3 by 60 into 45 into 365. That's the cost in highway X. Any doubts on this? Then comes highway Y. Broadly same thing, but it is 8,000 vehicles now. 8,000 vehicles. And the delay is not 1.3 minutes, the delay is only 1.2 minutes. Delay is only 1.2 minutes. $8,000 vehicles into 50% into 1.2 by 60 into 45 into 365. Into 45 into 365. Basic thing is I am not writing those two split, we have converted them into a single time, which is 45 rupees per hour. Any doubts on this?
So whatever is the expenditure before the flyover will become a benefit after?
Obviously, because that's a saving. No, actually a lot of projects are cost reduction. So I am doing this because I am going to save cost. Otherwise I will not end up doing this. The purpose of doing this is to save cost. Okay, next another saving which will come to the user is saving of the stop and start. So next, saving in stop and start, saving in stop and start, savings in stop and start, okay. Now listen again, I have 10,000 vehicles, 50% of them are going to delay this, 10,000 vehicles, 50% are going to delay. Now listen, the cost of start and stop is 1.2 for commercial vehicle and 0.80 for private vehicle. Now let's not understand it as 1.2 and 0.80. Let's take a weighted average first. Weighted average is 1.2 into 30% of the traffic and 0.8 into 70% of the traffic. 1.2 into 30% of the traffic. Every time there is a start and a stop, 1.2 is the cost for a commercial vehicle, 0.8 is the cost for a private vehicle. I don't want to know commercial, I don't want to know private, I will take a blended number. The blended number is 1.2 into 30%, 0.80 into 70%. How much does that come to? 0.92. So the cost is 0.92 for every time there is a start and stop. Every time there is a start and stop, I have to incur this 0.92. How did this 0.92 come as a weighted average? This is the cost in a single day into 365. 10,000 into 50% into 0.92 into 365. So assumption is wherever there is a delay happening in the traffic, there only the start and stop will happen. Otherwise, the normal traffic will anyway smoothly move. Ideally, that should smoothly move. So this will be the savings in stop and start for highway X. Highway Y broadly the same, the number of vehicles will undergo a change. Savings in stop and start. So again, this is a savings for the users. This is a savings in stop and start. Apart from this, accidents are not going to happen. That is also saving to the user. Now listen, it directly doesn't, whatever accident, the settlement they are happening, that is the saving. It's not technically the saving for the end user, it's technically the saving for insurance companies, but still that will be considered as a saving because that's a saving arising out of the flyover which is getting constructed. So the next is savings in accidents. Fatal and non-fatal. So that will come in the second part because policeman is part of the cost to the this one. So they have given two parts to the question. The first part says total net benefit to the user, annual cost to the state. So policeman will go to the state side. Saving or cost will go there. So the traffic lights, maintenance, all will go to the annual cost to the state side. From an user point of view, only 4 things. What are the 4 things is, first, I save on delay. So this para is fully done, that's all. I don't have anything beyond this in this first para. We are done with the first para fully. Second para, broadly we are done except that policeman part. We are now doing the accident part, and then we will see the other part. Now coming to the accident part, how many fatal accidents have happened? Due to failure to obey traffic signals, 8 fatal accidents and 16 non-fatal accidents occurred in last 4 years. Last 4 years, I am doing calculation everything for a year as of now. So 8 accidents divided by 4 years. What's the cost of a fatal accident? 5 lakhs. 8 accidents divided by 4 years into 5 lakhs. 8 accidents divided by 4 years into 5 lakhs. Divide by 4 years into 5 lakhs. When it comes to non-fatal, 60 accidents divided by 4 years into 15,000. 60 accidents divided by 4 years into 15,000. That is as far as non-fatal is concerned. Fatal is 10 lakh savings and non-fatal is 2,25,000 saving. Fatal 10 lakhs, non-fatal is 2,25,000. Fatal accidents we save 10 lakh rupees, non-fatal we save 2,25,000 rupees. Okay. To do all the savings, I have to spend little extra. So next is extra running cost. Technically there is one issue with the question, I'll explain when I come to this now. Extra running cost, highway X, highway Y. Now listen, to eliminate the delay of traffic and accident cost due to traffic violation, the flyover has been designed. It will add some distance and all dimension. Okay, first let's do a blended of this 5 and 2. So the cost per extra kilometer is going to be 5 rupees into 30% plus 2 rupees into 70%. The traffic mix is 30-70. So 5 rupees into 30% plus 2 rupees into 70%. That number is 2.90. The number is 2.90. 5 rupees into 30% plus 2 rupees into 70%. So you will end up getting 2.90. That's the extra cost. 2.90 is the extra cost. The problem is, if I look at highway X, the calculation is like this: 10,000 vehicles. The vehicles are going to be 10,000. It will add quarter of kilometer. So quarter of kilometer is 0.25. It will add quarter of kilometer 0.25 to the 20% of the total traffic. It's not for the entire route. Extra addition will happen. It will happen only to the 20% of the route. The only problem is I should then multiply this with the distance of the highway, which I have not done, or the distance of the flyover, because it says it will add a quarter of kilometer to the distance of 20% of the total traffic. So 0.25 is the extra addition to the 20% of the total traffic. Indirectly, institute has just ended with this. If I leave at this stage, understanding is the distance is only 1 kilometer. The distance is only 1 kilometer. The flyover distance could be, wait, I don't think so anywhere. Okay, the understanding is the flyover distance is 1 kilometer. Because you are constructing the flyover, 20% of them gets impacted, and because of the 20% impact, another 0.25 is the extra distance. So 10,000 kilometers into 0.25 kilometer into 0.20 into 2.9 into 365. 365 days in a year. 10,000 vehicles, this will be for all 10,000 vehicles, because be it delayed vehicle or non-delayed vehicle, everyone traffic will go up, the distance will go up. 10,000 vehicles into quarter of kilometer, which is 0.25, into 20% of the distance, into 2.9, 2.9 is a blended number, into 365. So write this, highway X, 10,000 vehicles into 0.25 into 0.20, 10,000 vehicles into 0.25 into 0.20, 2.9 is a blended number, which if you want you can just show the calculation somewhere. 10,000, 2.9 is this, 5 into 30% plus 2 into 70%, the same mix, na, 30-70. So 3 places we have taken the same mix, 5 into 30% plus 2 into 70%. The other one will be 8,000 vehicle and the same numbers. This you can put it as negative because this is an extra cost. $10,000 vehicles into 25% of the distance, sorry, into 25% of the kilometer, 20% of the distance, 2.9 and 365. This will be the net benefits to the users. From an user point of view, every year, this is an annual benefit, net benefits to the users. $63,87,925 is a per year saving. 63,87,925 is a per year saving. $63,87,925 net benefits to the users. Any doubts on this? Okay, next, working note 2, calculation of annual cost to state. Calculation of annual cost to state. Again, particulars calculation amount. We will first do the calculation. There are two types of costs which are going to happen. One is a flyover cost and second is a recurring cost. Let's first write the recurring cost and then we'll come to the capital cost of 3 crore. Calculation of annual cost to state. Calculation of annual cost to state. Now listen. Let's read from the beginning. Till this we have considered, one policeman is required to be posted for 3 hours a day at the crossing, which cost 150 per hour, and they are saying no posting of policemen will be required at the flyover. No posting of policemen will be required at the flyover. So this is also not a cost, this also is a benefit. From a cost state point of view also there is a benefit. Let's first write that benefit. The first benefit is saving in, you are going to write this as negative now because we are calculating the cost, saving in policeman cost, saving in policeman cost, savings in policeman cost, the saving is one policeman is required to be posted for 3 hours a day at the crossing which costs 150 per hour. 3 hours into 150 per hour into 365 days. 3 hours into 150 per hour into 365 days. Saving in policeman cost 3 hours into 150 per hour into 365. Clear? I'll come to the 3 crore cost in some time. This is a saving for the state. State is the municipal corporation. They also incur some extra expense. What they mentioned? Extra maintenance cost. Operation is to the user. Extra maintenance cost 70,000. Extra maintenance cost 70,000. Extra maintenance cost 70,000. They mentioned in the last line extra maintenance cost would be 70,000 a year. Last line of your page 183, extra maintenance cost would be 70,000 a year. So this is an extra cost for the state. Okay. Apart from this, there are no other expenses except the initial flyover. Flyover is a single year cost, or it is for all 30 years put together a cost? It's a one time cost, that's all. It's not every year I'm going to incur this. Now listen. Listen. Whenever we have to convert, listen, a new concept is going to come. Annual cost of flyover. If you want to know what is the annual cost of flyover, what is the cost of the flyover? 3 crores. Listen, you cannot say that I'll divide by 30 years and say that that's the annual cost of flyover. No, not divide by 30 years. It has to be divided by present value annuity factor of 30% and 30 years, and what is the rate of cost of capital given in the equation? 8%. Listen, whenever I'm incurring a single cost, so somebody says I incur 5 lakhs on a vehicle and every year my cost is 1 lakh over the next 5 years. No, it's not 1 lakh. Why it's not 1 lakh is 5 lakh is incurred today. 1 lakh of year 1 plus 1 lakh of year 2 plus 1 lakh of year 3 plus 1 lakh of year 4, 5 cannot add up to 5 lakh because cash flows happening at different points of time have a different value. So whenever you incur a one time cost, now for example, if somebody says this laptop is bought for 50,000 and it has a life of 4 years, the per year cost is not 12,500, the per year cost is 50,000. Though in depreciation you can do all of that, I'm not really bothered about it. From a FM point of view, the cost per year is 50,000 divided by present value annuity factor, 4 years and the return which you want, whatever could be the return. So in this case, this guy wants a return of 8%, so 30 years and 8%. Now I want you to calculate the annuity factor for 30 years and 8%. 1 divided by 1.08 equal to M plus 30 years and MRC. 1 divided by 1.08, 30 years annuity factor. One divided by 1.08. How much? 11.26. Okay, now listen. If you do in the calculator, you get 11.26 is what I assume. Now listen. 1 divided by 11.26, you get a number. Okay. That number is technically called as capital recovery factor. Opposite, inverse of annuity factor is capital recovery factor. So you can say the annual cost of flyover is 3 crore by annuity factor or 3 crore into capital recovery factor. What is capital recovery factor is? 1 divided by present value annuity factor. Capital recovery factor is nothing but inverse of annuity factor. That is, listen, you told me 3 crores. I can divide by 11.26, the number which you said, or I can even multiply it with 0.0888. Both will give me the same answer except for the rounding of differences. Except for the rounding of differences. Either you do in the calculator and get something called as present value annuity factor. If I don't want to get the annuity factor, I can use the capital recovery factor which is given in the question. Somebody wants to do still as annuity factor, you don't do in your calculator, you do 1 divided by capital recovery factor. 1 divided by capital recovery factor will give you the annuity factor, and then divide by the annuity factor. Both are same. So if I have, why it is called as capital recovery factor is, it's basically trying to indicate what is the cost at an every year level. So it's an inverse of your annuity factor. It's inverse of annuity factor. Your annual cost of flyover is one of the two, whatever way you want to call it. I will use the capital recovery factor because that is given in the question. The capital recovery factor is given in the question, so we will use that. Now write annual cost of flyover equal to, in the calculation column, annual cost of flyover 3 crore into 3 crore into capital recovery factor. 3 crore into capital recovery factor. 3 crore into capital recovery factor. 3 crore into capital recovery factor into capital recovery factor, and this number is annual cost to state. To construct flyover, I am going to spend 25 lakh rupees every year, which is spent as one go. 3 crore is spent as one go, but logically speaking, our annual cost is 25 lakh 69,750. 25 69 750. The important term is capital recovery factor, which I am introducing here. Capital recovery factor is nothing but inverse of annuity factor. Inverse of annuity factor. Policeman is not going to the working note 1, or extra maintenance is not going to working note 1, because that's not for the users, that is for the state. State is going to save. State is basically municipal corporation. They are going to save this. They are going to save this, or they are going to spend this, whatever way we want to call it. Clear? Now third part is saying benefit cost ratio. I am not doing a separate working note. Benefit cost ratios, benefit is working note 1, cost is working note 2. Benefit is working note 1, cost is working note 2. Benefit cost ratio is nothing but profitability index. It's the other name for profitability index. Benefit is working note 1, cost is working note 2. Divide, you can express in percentage, you can express in times. I'll express in times. The benefits are 2.49 times of the cost. Benefits are 2.49 times of the cost. Benefits are 2.49 times of the cost. Benefit cost ratio, benefit is 2.49 times of the cost. Clear? So we first calculated the benefits to the users, then we calculated the cost to the state, and when we divide benefits by cost, we will end up getting this ratio. Any doubts on this? 2.49 times is the benefit cost ratio. Let's move to question 7 then. Go through question 7. Okay, now coming to this question, a venture capital financier is planning to invest 45 crores which will give him 600 crores if the project succeed. It may be possible that the project may fail at any time during the 6 years. The following table provides the estimates of failure. In the above table, the probability that the project fails for the second year is given, that it has survived throughout year 1. Equity investment beta, all that information is given. You are required to compute the NPV of the venture capital project and advise the TMC. Now listen, my initial outflow is 45 crores and return which I am going to get is 600 crores, but the problem is the project may not even survive. So I have to find what is the probability of the success of the project. Now listen, probability of success is equal to, listen, the project can fail in the first year. So what is probability of success is probability of success in year 1 into probability of success in year 2 into probability of success in year 3, year 4, year 5, year 6. It has to survive all the years and reach the end. It can fail at any point of time in between. So there's something called as joint probability. When I toss one coin and if I have to get the probability of one head, it is 1 by 2. But 2 tosses and 2 heads is 1 by 2 into 1 by 2. 3 coins, 3 tosses become more difficult. 1 by 2 into 1 by 2 into 1 by 2. 4 coins and 4 heads if you want. 1 by 2, 1 by 2, 1 by 2. It become 1 by 16. A very rare possibility that you toss 4 coins and all 4 turns out to be heads. So that is what here it is. So probability of success is, there is a 0.72 probability that it will succeed in year 1. After it succeeds in year 1, it has a 0.75 probability that it will success in year 2. It has to first succeed in year 1, then succeed in year 2, then succeed in year 3, then succeed in year 4, year 5, and finally it has to survive the last year. This is the probability that project will survive throughout the 6 years. This is the probability that project can survive throughout the 6 years. 0.72 in the first year, 0.75 in the second year, 0.78 in the third year, 0.82 for the fourth year, 0.82 for the fifth year, and 0.90 for the last year. It's a joint probability. It is not that succeeding only in year 1 or year 2. It has to go till the end. If it has to go till the end, it has to meet all of this. So now write probability of success of project equal to probability of success of project equal to probability of success in year 1, probability of success in year 1 into probability of success in year 2 into dot dot dot. It refers to 6 years. Probability of success in year 1 into probability of success in year 2 dot 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 into probability of success in year 6 finally. Year 1, year 2 dot 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 year 6. Probability of success in year 1 into year 2 into lastly year 6 equal to 0.72. What is probability of success is 1 minus the probability of failure. 0.72, 0.75, 0.78, 0.82, 0.82 and finally 0.90. Multiply this and give me whatever number of decimals you get. It's fine. Give me with those set of decimals itself. Point 339. Okay, ठीक है, maybe 5 decimals would do. This is the probability of the success. The amount is used, that's why I wanted to write more decimals. 0.25489 is the probability. The probability of project succeeding is 0.254893392. Surviving for the 6 year period, it can fail at any point of time. Another thing which I have to do is cost of capital is equal to RF plus beta into RM minus RF, RF plus beta into RM minus RF. The figures are given in the question. Risk-free rate plus beta into RM minus RF, RF plus beta into RM minus RF. What's the RF given? 6%, beta 7, a high risk project, 8 minus 6, 6 plus 7 into 8 minus 6, risk free rate of 6%, beta of 7 times into 8 minus 6. What number you get? This is not a critical adjustment, this is something which we have been doing multiple places. So my discount rate is going to be 20%. Discount rate is going to be 20%. RF plus beta into RM minus RF. Now what we are going to do is, we are going to calculate the NPV next. Computation of NPV. Computation of NPV. Year, cash flow, PVF at 20% and DCF. Year, cash flow, PVF at 20% and DCF. Year, cash flow, PVF for 20% and DCF. Okay. Now, listen, I have an outflow on day 0 and inflow at the end of year 6. What is outflow? 45 crores. Inflow is not 600 crores. Inflow is 600 into this probability 0.2548933992. This is what is the inflow which I am going to get out of the project. I am not going to get the entire amount. I will get an inflow of 152.94 crores. Why 152.94 is, sometimes you will fail, sometimes you will succeed. On an average, you will get 600 crores few years, 0 sometimes. On an average, it's 152 crore. This is called as expected cash flow. Probability into cash flow is called as expected cash flow. So 600 crores into this probability 152.94 is what we are going to get. $600 crore is the cash flow. There is a probability attached to this cash flow. The probability of getting the 600 crores is that 0.2549 whatever we have calculated, 0.2548933992. This is the probability that you will get this. So 600 crores into this is the cash flow which I will get. This is technically called as expected cash flow and expected NPV. The NPV of the project is 6.23 CR. This is the expected NPV of the project. Any doubts on this? Clear? Okay. Question 8 is something you can manage at home. It is not something difficult. We'll move to question 9. ABC Limited has been regularly paying a dividend of 15 lakhs per annum for several years. It is expected that this dividend would continue at this level in near future. 10 lakh equity shares of 10 each being traded at par. Company has an opportunity to invest 10 lakh in 1 year and a similar amount in 2 years, which will generate 4 lakh for every year starting in 3 years, is by paying a reduced dividend. Analyze the effect on the market price of the share if the company decide to go ahead with the project. Please go through the question. Okay. Now coming to this question, ABC Limited has been paying some dividend. They are saying this level of dividend would continue at this level in near future, which means there is no growth in the company. Same amount of dividend. There are 10 lakh equity shares of 10 each. The company has an opportunity to invest 10 lakh in 1 year and a similar amount in 2 years, and it will generate an equal cash flow 4 lakh for every year starting in 3 years time. So, I am going to invest 10 lakh in first year, 10 lakh in second year, and I will get a perpetuity from 4 lakh, perpetuity from year 3 onwards. They are saying I have to reduce dividend. I am really not bothered about all of this. We are basically going to do year, cash flow, PVF, DCF. Year 1 outflow of 4 lakhs, year 1 outflow of 10 lakhs, year 2 another 10 lakhs, year 3 onwards there is a perpetuity which I have to value. To do all of this, I will have to first calculate the cost of equity or cost of capital. To do cost of equity, which formula will we use? I need the cost of equity. We need a discount rate in this question. How will we get a discount rate? There is a need for a discount rate, then we can analyze the cash flows and all. That will be per share dividend. You are going in the right direction. That is a per share dividend. Then okay. When we did Gordon's, I would have given you this formula. K is equal to D1 by P naught plus growth rate. R at IPCC would have learned this. K is equal to D1 by P naught plus growth rate. Dividend divided by the current market price plus the growth rate. Let us start. Point number 1, computation of cost of equity. Computation of cost of equity. Computation of cost of equity. KE equal to D1 by P naught plus growth rate. KE equal to D1 by P naught plus growth rate. They have given the dividends for so many shares. At a per share level, what is the dividend for a single share? 1.5. This is what was happening in the company, 1.5. K is equal to, dividend is 15 lakh divided by 10 lakh shares. Market price is 10 rupees being traded at par. It is being traded at par. So, the market price is 10 rupees. 1.5 by 10 plus 0%, no growth. 1.5 cost of equities D1 is 15 lakh divided by 10 lakh shares. Current market price is 10 rupees being traded at par. It's being traded at par. So the current market price is 10 rupees. 1.5 by 10 plus growth rate is 0%. And cost of equity is how much? Cost of equity is 15%. Cost of equity is 15%. Clear? Any doubts on this? D1 by P naught plus growth rate. KE is 15%. Done. Next, computation of NPV. Computation of NPV, year, cash flow, PVF, DCF. Computation of NPV, year, cash flow, PVF, DCF. Discounting will happen at 15%. Year, cash flow, PVF, DCF. We are going to do discounting of cash flows at the rate of 15%. Year, cash flow, PVF at 15% and DCF. Let's not worry whether they are going to declare dividend, reduce dividend. I'm not bothered about all of this. I'm just evaluating this project. What is the outflow for this project in year 0? Outflow for the project in year 0. No, nothing is there. Outflow is year 0. They have not mentioned anything specifically for year 0. They said that they will reduce 10 lakhs in year 1. Logically, it may not make sense because I will initially start some investment and then start a project. But question has given me that way. The wording state that it will invest 10 lakh in 1 year's time. In 1 year's time and another 10 lakhs in 2 years' time. So the wordings have been specified that way. So year 1 negative 10 lakhs, year 1 negative 10 lakhs, year 2 negative 10 lakhs, year 2 negative 10 lakhs. The wordings state that it will be done in 1 year. Year 1 negative 10 lakhs, year 2 negative 10 lakhs, negative 10 lakhs in year 1, negative 10 lakhs in year 2. Negative 10 lakhs in year 1, negative 10 lakhs in year 2. I'm going to get a perpetuity. Can you value the perpetuity? How will you value this perpetuity? 4 lakh divided by KE. Your value of perpetuity is 4 lakh divided by 15%. Write the perpetuity. 4 lakh divided by 15%. Perpetuity is perpetuity amount divided by the cost of capital or cost of equity. 4 lakh divided by 15%, 4 lakh divided by 15%, 4 lakh divided by 15%, 26 lakh 66,667. 4 lakhs divided by 15%, 26 lakh 66,667. I'll compute the NPV now. Any doubts on this? Perpetuity value is, it is nothing but this formula itself. The same formula. 15% is equal to 4 lakh divided by, 15% is equal to, it's like this, 15%, 4 lakh divided by P naught. So you will get the P naught or the value of perpetuity. The value of perpetuity is 26 lakh 66,667. Any doubts on this? Okay, wait. There's a mistake done here. Can you spot the mistake? There is a mistake here. I've done a mistake. Which one? Could be anywhere. There is a mistake, yes. You're going, what is the mistake you see? Yes. So when should I write then? Which year? Yes, it's a year 2 cash flow. Perpetuity is valued a year in advance. Perpetuity, I have repeated this maybe some 15 times till now. I keep repeating, I don't know, students still keep making the same mistake. They keep making the same mistake. The logic for that is this. For P naught, it is D1 by KE. So similarly, when you are valuing your 3rd year cash flow, the value will be written in the 2nd year. The value is going to be written in the 2nd year. Perpetuity is always valued a year in advance. The year for this is technically 3 to infinity. I cannot write 3 to infinity and all. So I write a year in advance, which is year 2. Perpetuity is always valued a year in advance. It's always valued a year in advance. We have done this multiple times, but still we keep making the same mistakes. This is the NPV of the project. The most important part is you have to value a perpetuity a year in advance. That rule has to be followed properly. Perpetuity is to be valued a year in advance. So the value of that NPV is 3,90,000. They have finally asked, analyze the effect on the market price if the company decides to go ahead. So I'll explain that now. Any doubts on 3,90,000? Any doubts on 3,90,000? Okay. After calculating the NPV, the question did not ask us to calculate NPV. They just asked what is the effect on the market price. If I do a positive NPV project, market price will go up by NPV per share. Basically, the market cap will go up by the amount of NPV. This 3,90,000 will be shared by 10 lakh. So indirectly, the share price will go up by 39 paise. The share price will go up by 39 paise. That's the impact. Positive NPV, share price will go up. Negative NPV, share price will come down. So next you can write NPV per share. NPV per share equal to 3,90,000 by 10 lakhs. NPV per share equal to 3,90,000. 3,90,000. NPV per share. அந்த இதா அவர் ப்ரொஜெக்டர் யூஸ் பண்ணுறாங்க வச்சன் சார். NPV per share is 3,90,000 divided by 10 lakh, which is 0.39. NPV per share is 0.39. You can write the company is undertaking a positive NPV project. The company is undertaking a positive NPV project. Undertaking a positive NPV project. Positive NPV project. Positive NPV project, and hence share price will go up. And hence share price will go up by. And hence share price will go up by 0.39 per share. Share price will go up by 0.39 per share. Share price will go up by 0.39 per share. Will go up by 0.39 per share. Now that is as far as the second topic is concerned. Now we'll move to the third topic, which is replacement decision. We are done with basics, we are done with investment. So technically there are three types of decision which can happen. One is called as new purchase, Second is called as abandonment. Abandonment is giving up your existing asset, not that critical. We will discuss it in between here itself. And the third is replacement. Replacement is buying a new asset in place of old asset. Rules remain the same. Step 1 initial outflow, step 2 in between flow, step 3 terminal flow, consolidate, calculate NPV and then make the decision. I am not going to change any of this. The only thing is, when you do replacement decision, there are two approaches. In first approach, what you do is, if there are two machines, machine X you analyze separately, machine Y you analyze separately, calculate NPV, whichever gives better NPV you select that, and there will also be an old machine. Replacement means you are buying a new machine in place of old machine. Old machine can also have some NPV on its own. So, in a replacement problem, I have two methods. One is called as incremental method and second is called as non-incremental method. In a non-incremental method, machine X analyzed separately, machine Y analyzed separately, machine Z analyzed separately. You analyze everything separately. After analyzing everything separately, you compute the NPV and then decide whether it's a positive and whichever has the highest NPV, you select that. In incremental method, what you do is at every stage, I'll compare the old machine and the new machine and find out what extra is happening. Predominantly, we are going to follow incremental method. If at all they give details on the cash flows, predominantly it will be incremental method, that is analyze the old machine and new machine together. So, when you are setting up a project, initial outflow will not have only few items, it will have capital expenditure, working capital, it will also have less or inflow called as sale value of old machine. There will be an inflow called as sale value of old machine. When you do in between flow, we will not write revenues, we will write incremental revenues. What is incremental revenues? New revenues minus old revenue. We will not write all the cost, we will again write incremental cost, which is new cost minus old cost. Incremental PBDT, incremental CFAT. Similarly, when you do terminal flow, you are going to write only the incremental number. So, we are going to work it that way. So, that is called as replacement decision. Let me just see what I have covered in the theory part, just a minute. Steps is fine. Okay, nothing much. I think whatever I have discussed is only there. So, I will directly get into problems now. So, we will start with this question 1. It is a detailed problem. It will explain you everything what we are trying to understand in this topic. Go through question 1. Okay, one more thing, this question will have scope for multiple assumptions because certain points the way we assume will change and our answer can change with institute material, because if all our assumptions are in line with what they have taken, answer will match, otherwise there will be a difference. ABC Limited manufactures small rubber components for the local market. It is presently using 8 machines which were acquired 3 years ago at a cost of 18 lakhs, having a useful life of 8 years with no salvage value. Now, this indicates that I have another 5 years of life pending for the existing machine. The machine had a 8-year life, we have bought them 3 years ago, so another 5 years is there. The company policies, they depreciate the machines in 5 years. Production capacity annual demand. Capacity is 37 lakh units, demand is 30 lakh units. Company has received an order from a leading automobile company for the supply of 20 lakh bushes at rupees 15 per unit. Now the issue is my capacity is 37 lakh, utilization is 30 lakh, I cannot accept this order of 20 lakh bushes, because if I accept this order of 20 lakh bushes, I cannot meet it, I do not have the production capacity. Now they are bringing in a concept saying that you can sell your existing machine for 12 lakhs, some removal cost is there, and you can buy new machines, 3 machines which have a combined capacity of 52 lakh units. So this basically is a revenue enhancement project, because I will buy new machineries and I will increase my revenues. Some operating parameters of the existing machines are given and additional machines is given. Company follows SLM, corporate tax rate, cost of capital, should the company replace the machine. So that's the net requirement. Should I go ahead and replace the machine? We'll go through those series of steps. I'll keep asking you information. We will search them and then write. Working note 1, initial outflow. Working note 1, initial outflow. Initial outflow. Particulars, calculation amount. Particulars, calculation amount. Working note 1, initial outflow. Particulars, calculation amount. Point number 1, capital expenditure on new machine. Capital expenditure on new machines. You use a pencil or you keep ticking the point, because it's too much, we may end up missing up a lot of information. So if I write this, then you can put a tick so that we don't go to that line. What is the capital expenditure on new machine? 100 lakhs each. So we are done with analyzing this point. 100 lakhs each, and there are totally 3 machines. There are totally 3 machines. So I'll write minus 300 in right side in lakhs. Solve the problem in lakhs. Minus 300. Capital expenditure on new machines minus 300. Capital expenditure on new machines minus 300. Working capital. Working capital. Now they are saying additional working capital needed is 50 lakhs. The projected operating parameters with the replacement by the new machines are as follows. Additional working capital is 50 lakhs. So working capital is minus 50. This is an extra amount I have to spend. Working capital is 50 lakhs. Additional working capital minus 50. Working capital is 50 lakhs. Okay, now listen. Net salvage value of old machine, not sale value. Net salvage value means there is going to be tax impact also. Net salvage value of old machine in bracket note 1. Net salvage value of old machine. Net salvage value of old machine. Note 1. Calculation of NSV. Calculation of NSV. Calculation of NSV. How many old machines are there? 8. Sale value, you will sell 8 machines for what price? What is the sale value of these 8 machines? It is not 12 lakhs, we will take it as 11.4 lakhs. Why 11.4 is I incur a removal cost of 60,000. I am not going to get entire 12 lakh rupees, I will get only 11.4 lakh rupee per machine. So sale values 8 into 11.4. Sale values 8 into 11.4. 8 into 11.4. Sale values 8 into 11.4. Sale values 8 into 11.4. Any doubts on this? Okay, next is book value. Listen, we bought these machineries at what price? Let's take one machinery, 18 lakhs. I have purchased one machinery for 18 lakhs. Listen for some time. What is the life of the machine? Original, okay, originally 8 years. What was the salvage value? 0. So 8-year life, 0 salvage value, 18 lakh cost of the asset. But the problem is, the question says the company wants to depreciate it in 5 years, and last line says it's allowed for tax purpose. So if the problem was silent, the book value would have been 18 minus 18 by 8 into 3. What is 18 by 8 into 3? Is 3 years depreciation. 18 minus 18 by 8. 18 by 8 is the depreciation for a single year into 3 years. Now I will do the same thing, but it is divided by 5. 18 by 5 into 3. This will give me the book value per machine. 18 lakhs minus 18 by 5 into 3. 18 lakhs minus 18 by 5 into 3. Get that value. 18 lakhs. This is the book value per machine. So the calculation is 18 lakhs minus 18 lakhs by 5 into 3. 18 lakhs by 5 into 3, and we'll finally multiply this by 8 machines. I'll finally multiply by 8 machines. 18 lakhs, basically it is 7.2 into 8. 7.2 into 8. $18 lakhs by 5 machines into 3. Any doubts on 57.6? This is capital gain. Capital gain. I'm going to make this amount of capital gain. Capital gain. 33.6 lakhs of capital gain. 33.6 lakhs of capital gain. Tax paid. If there is a gain, I'll have to pay tax. Tax paid. We'll do all our calculation finally at 2 decimal level. What's the tax rate? 35% into 0.35. I'll have to pay tax of 11.76 lakhs. Tax of 11.76 lakhs. Tax of 11.76 lakhs. Listen, net salvage value is nothing but sale value minus tax. There is no continuation of this line. Ideally, maybe okay, leave a line gap in between. And net salvage value is sale value minus tax paid. Sale value minus tax paid, or sale value plus tax saved. So by selling old machine, I will generate 79 lakh rupees. By selling the old machines, we will generate 79 lakh rupees. Will generate 79 lakh rupees. And this number will go here. This is an inflow, so positive. 79.44 is an inflow. This is a positive item. 79.44 is inflow. And we get the initial outflow. Initial outflow of 270.56. Initial outflow of 270.56. That's the initial outflow for buying these machines. Any doubts on this? Can we proceed? Any doubts on this? Working note 2, in between flows. Okay, sorry. There is one more expense. Sorry, I not read. Okay, sorry about it. If you read the question fully, you will see this item. Laying cost of 34 workers, unskilled, skilled supervisor, 9,21,000 equivalent to 6 months salary. That is, when I am going to bring the new machines, the requirement of people come down. Once the requirement of people comes down, I will have to tell them to quit the company. When I am telling them to quit the company, I have to pay this 9,21,000. Laying of cost of employees. There is a cost to be paid because I am telling them, boss, I have bought an automated machine or something and we don't need your service now. So this is also part of my initial outflow. Sorry about it. You will have to capture this. Wait for a minute. Laying of cost. The amount is 9.21 lakhs and I assume that I immediately get the tax benefit. You can take an alternate assumption saying that you get the tax benefit at the end of the year. But this 9.21 is year 0 outflow. Whether you want to consider it as year 1 tax saving or immediate tax saving, that's up to you. But this is an initial outflow because when I start the project, I have to tell these employees to quit the company. 9.21 lakhs into 65%. Why 65% is after tax? This is a part of initial outflow. Write this. $9.21 lakhs into 65%. 9.21 lakhs into 65%. Clear? Okay. Now we'll go to working note to in between flows. Particulars in 5 years. Particulars in 5 years. Okay, listen, we are not going to do the calculation first. Let's first capture what are items going to come so that we don't miss out on anything. Let's look at now. Listen, the first thing is, because of this machinery, whatever we are bringing in, there is going to be extra revenues. I will have to do this in note 2. Listen for some time. Revenues, we will have to do this in note 2. Old revenues, new revenues and incremental revenues. I will capture only the incremental here. Second part, the operating parameters of the existing machine are as follows. Labor requirements. Okay, so there is a labor requirement. So listen, what I will do is I will write labor cost in bracket note 3. What you will do in note 3 is existing labor cost, new labor cost. If you save, put it as positive. If you spend more, put it as negative. So there is going to be a labor cost item. Then there is raw material cost, which is note 4. In raw material cost, you will again calculate old raw material cost. Old raw material cost is 60% of revenue. New raw material cost is 50% of revenue. Then we have maintenance cost. This I don't need a working note, I can maybe as well do it directly itself. Then we have operating expenses. If I need a working note, we'll capture it in some time. As of now, I'm just calculating, writing whatever it is. Then we have insurance cost. Insurance cost. So I've captured labor, raw material, maintenance, operating, insurance. Working capital is captured. There is some savings in cost of utility. Let me write it as cost of utility. Later on we'll decide how do we want to write positive, negative, we'll decide in some time. Maintenance cost is already written, raw material written, employee requirement is written, laying cost of 50 workers is already written, and the next item, final item is depreciation, and we will get PBT. We'll get PBT. Now write this format. We will do a separate working note for every line item here. Particulars year 1 to year 5. If needed, we will do a separate note, or we can do the calculation in the calculator. We'll see depending on the question, depending on the point. Particulars and 5 years. Revenues, labor cost, raw material cost, maintenance. I'm just copying those numbers which are given. Operating, insurance, utilities, depreciation and PBT. Finally, we'll have to come down to PBT. Revenues, labor cost, raw material, maintenance, operating, insurance, utility, depreciation and PBT. Come down, note 2, calculation of revenues. Note 2, calculation of revenues. Particulars in 5 years. Particulars in 5 years, calculation of revenues, particulars in 5 years, revenues of old machine, revenues of new machine, incremental revenues. Note 2, calculation of revenues, particulars in 5 years, revenues of old machine, revenues of new machine and incremental revenues. Old, new, incremental, old, new and incremental. Okay, old machine was selling how many units? Capacity was 37, but we were selling only 30 lakh units. We were selling 30 lakh units and the selling price for the existing was 15. The selling price for existing was 15. So the old machine was generating this revenue every year. 30 into 15, 30 lakh units into 15 rupees, 30 lakh units into 15 rupees. New machine is this plus 20 lakh units into 15 rupees. Listen, I am not doing 50 lakh into 15 because sometimes that extra units would be sold at 12 or 10 rupees. Extra units alone, because that's a special order. The special order alone could be at a lower price. Sometimes it can happen. Here I can even write 50 lakh units into 15, but why we are writing old plus 20 into 15 is it can change sometimes. Instead of 15 rupees, it can be 12 rupees also. So this is my new revenues. Revenues from new machine. Technically it's 50 lakh units into 15 rupees. 50 lakh units into 15 rupees. This 300 will go to the main working note. Ideally, I don't need a working note for this, but you'll understand as we proceed why I have calculated this specifically. So revenues are 300. Incremental revenues are 300. Revenues of old machine, revenues of new machine and incremental revenues. Old, new, incremental. Any doubts on this? Note 3, what was the note 3 for? Calculation of Okay, note 3, calculation of labor cost. Calculation of labor cost. Labor cost of old machine, labor cost of new machine, and whether it is saving or cost will come in some time. Labor cost of old machine, labor cost of new machine. Labor cost of old machine, labor cost of new machine will come to incremental or savings in some time. Okay, read the line on old machine and tell me what will be the cost. Do the appropriate multiplication and tell me the cost. Their per month salaries are given. Do the multiplication. $18 into 3,500 into 12 plus 18 into 5,500 into 12. So, adding all of this, what number do you get? 18 employees into 3,500 into 12, 18 employees, 22. Okay, let others also just complete. Are you getting 22,98,000? Just confirm that. 18 into 3,500 into 12, 22,98,000. Okay. So listen, it's 22.98 for the first year. Second year onwards, this amount will increase by 10%. Will increase by 10%. Why will it increase by 10%? To give effect to inflation. I'll have to give extra salaries to employees. So 22.98 in the first year and it increases by 10%. Do this. 22.98 and thereafter increase by 10%. 22.98 and thereafter increase by 10%. Increase by 10%, 22.98. You'll have to multiply, no? 18 into 3,500 into 12. 18 employees into 3,500 into 12. 18 employees into 5,500 into 12. 3 employees into 6,500 into 12. And 2 employees into 5,000 into 12. 22.98 lakhs. R into 12 can be done in the end. You get a monthly salary and then finally do into 12. It's basically 18 into 3,500 plus 18 into 5,500 plus 3 into 6,500 plus 2 into 5,000 whole multiplied with 12. For the new machine, what is the labor requirement? 6 skilled at monthly salary of 7,000. Can you multiply and tell me the final figure? What do you need for a year? For a year, what is the labor cost? Year. 5 lakh? Any doubts on 22.98? This one is, how many employees were there? 6 into 7,000 plus 1 into 6,500 into 12, 5.82 lakhs. 5.82 lakhs is the labor cost of new machine. Clear? Okay, listen now. For the new machine, they have not explicitly mentioned that there is an inflation, but it's implied that if there is inflation for the labor in case of existing machine, these people wages will also increase by 10% year on year. It's an implied understanding that this will also increase by 10%. They need not explicitly mention this. If cost for old machine is going up by 10% every year, these people wages I have to increase in this case also, because inflation anyway is a common phenomena. So I will have to increase this by 10% every year. Increase it by 10% every year. you can subtract and write savings in labor cost then. It is going to increase by 10%. If old machine is increasing by 10%, by that logic new machine will also increase by 10%. New machine will also increase by 10%. And I am going to save this cost. The savings in labor cost, we can have extra cost or we can have savings. In this case, I see savings in labor cost. This is the amount of savings in labor cost. Labor cost, we save 17 lakhs, 18, 20, 22 and 25. Savings in labor cost 17, 18, 20, 22 and 25. Old machine labor cost increases by 10%, new machine will also increase by 10%. The logic remains the same. If old is going up, new will also go up by 10%. Any doubts on this? Next, raw material cost. Note 4, calculation of raw material cost. Note 4, calculation of savings is again an inflow there. I have written it as an inflow, that whatever labor cost is a positive item. In your calculation, when you go to the working note 2, revenues is positive, labor cost is also positive because I am saving money. Revenues is positive, labor cost is also positive. Calculation of raw material cost, RM of old machine, RM of new machine and savings in RM cost. RM of old machine, RM of new machine and not savings, we don't know what will happen. RM of old machine, RM of new machine, we will see that in some time whether it is savings or extra cost. RM of old, RM of new. What's the raw material cost of old machine they have mentioned? 60%, listen, it is 60% of revenue, new machine is how much? 55%. It may look like that there is a saving, but no, because your sales is also going up. So this is into 60% of 450 into 60% of 450, and the next one is into 55% of 750. That's why we wrote both, and there is no saving. I am going to incur extra cost. There is going to be extra cost in this case. Incremental RM cost. Incremental RM cost. Incremental raw material cost. We are going to spend extra rather than saving. Why are we spending extra is more because of the turnover. Incremental raw material cost 142.5. So this will come as a negative item. Some of these items I could have done it for only 1 year and return it. Some items we will have to do it for all years, some we could do it for 1 year and write the same amount every year. Raw material cost. Raw material cost 142.5. Raw material cost 142.5. Any doubts on this? Okay, coming to the maintenance part, okay, better to write a working note. Yeah, it's better to do a working note. Note 5. Note 5. This is a comprehensive problem. This will explain what is to be done in case of detailed analysis. Note 5, calculation of maintenance cost. Maintenance cost of old machine, maintenance cost of new machine, and whether it is extra or saving we'll see. Maintenance cost of old machine, maintenance cost of new machine. What is the maintenance cost of old machine? Okay, but how many years we have? We have only 5 years. So which number should I write? Which one? 67.5. So technically they have given me 8 years data. This is not 1 to 5 for me. This is minus 3 to 2. What is minus 3? Is 3 years already gone by. Third, minus 3, minus 2, minus 1, 1 and 2. So technically what I can do is 8th year is like the 5th year for me. 8th year is like the 5th year because 3 years have already gone by. 7th year is like 7th year is like 4th, 6th is like 4th, and then you see this 1 to 5 is how much? 22.5. So basic thing is they need not have given me 1 to 5 and 6 to 8. What I wanted from them is future. So it's not 1 to 5 and 6 to 8. This is 3 to 5. 3 to 5. And I don't want to know 1 to 5 and all. 3 years is already gone by. This is not 1 to 5. This is 1 to 2. First and the second year. The coming year and the next year you will incur 22.5. Third, fourth and fifth year you will incur 67.5. Third, fourth and fifth you will incur 67.5. 22.5, 22.5 for the first 2 years, and thereafter it is 67.5. 22.5 for the first 2 years, and thereafter it is going to be 67.5. The new machine cost is 7.5. Savings and maintenance cost. There is a savings and maintenance cost. I hope you are clear on this. Your maintenance cost is not 1 to 5 and 6 to 8. I want it as 1 to 2 and 3 to 5. 1 to 2 and 3 to 5. If they had just mentioned 1 to 5, I would have taken that number. I wouldn't be bothered about it. Just because they have added that 6 to 8, it indicates that they are telling for the 8-year life of the asset. We will copy these numbers. This is a savings, so inflow, positive item. Maintenance cost is inflow. I am writing it as positive item because this is going to increase my inflows. 15, 15, 15, 30, 30. Any doubts on this? Okay, now onwards I think will not be doing many working note. Coming to operating expenses, they mentioned, listen, 52.10 lakhs expected to increase annually by 5%. What they mentioned for the new machine? What is mentioned on new machine for operating expenses? Operating expenses of new machine. Anything mentioned? Anything mentioned on operating expenses? No. If the problem is silent, it means it is same operating expense and incremental will be 0. Old will be same, new will be same, additional is going to be 0. So operating expenses, I can write old machine, I will copy the same number for new machine. We'll copy the same number for new machine, and incremental is going to be 0. Operating expenses old and new is going to remain. Insurance note 6. Insurance is going to be note 6. Operating expenses is 0. Insurance cost of old machine, insurance cost of new machine, and we'll see whether there's a savings or extra cost. Insurance cost of old machine, insurance cost of new machine. Okay, now coming to the insurance, they have said premium year 1 2% of the original cost of the machine, afterwards discounted by 10%, afterwards discounted by 10%. 2% of the original cost, afterwards discounted by 10%. Now the only problem is, I am not sure what interpretation institute has taken. The original cost was 8 machines into 18 lakhs. Year 1 they have said it is 2% of the original cost. Now I have to interpret it in 2 ways. First way is 8 into 88, 8 into 18 into 2% is the cost. 8 into 18 into 2% is the cost for the year 1 insurance cost. I can also interpret this as saying that this year 1 is technically 3 years already gone by, because they said 2% of the original cost. So it could be like this also, that is today we are in 2019, so 2016, 2017, 2018 and 2019. In 2016 the cost would have been 8 into 18 into 2%, that is the 2% of the original cost. Next year is discounted by 10%, is this divided by 1.1. Discounted is divided by 1.1. Next year again divided by 1.1 and then divided by 1.1. It goes on like this. Now I have 2 ways of interpreting. I can say the 5-year insurance cost is this, starting with 2.88 and reducing at the rate of 1.1 divided by 1.1, or 2.88 would have been the insurance cost when we bought the machine, and thereafter it reduces, I am not sure what interpretation institute has taken. Why I have a doubt in this is because it says 2% of the original cost of the machine. Original cost, I normally understand that when you buy the machine that year this will be. Next year onwards, why did insurance premium reduces? Your WDV reduces, the asset value reduces, so insurance premium has to reduce. Let's take it as this interpretation, 2.16, 1.96, that is the calculation is 8 machines into 18% into, 8 machines into 18 lakhs into 2% divided by 1.1, which is year 2, again divided by 1.1, which is year 3, again divided by 1.1, which is year 4, the coming year. The coming year is called as year 4. So insurance cost calculation is, now do 8 into 18 lakhs into 2%, 8 into 18 lakhs into 2%, divide by 1.1, 1.1 and another 1.1, divide by 1.1, 1.1 and 1.1. If you divide by 1.1, you get the second year premium, another 1.1 gives you the third year premium, another 1.1 gives you the fourth year premium. Technically we are doing the calculation for the fourth year. The calculation is basically for the fourth year. 8 into 18 into 2% divide by 1.1, 1.1 and 1.1, and further you keep dividing by 1.1. Or we could have as well directly done into 2% as the first year premium. We could have taken that as the first year premium itself. Okay, another thing is this discounted also can be interpreted in two ways. Some authors will do into 0.9 into 0.9. So you take the number, you do into 0.9 for the first year, into 0.9 into 0.9. That is one way of doing it. Divided by 1.1 is the other way. Both will give you different answer. Both will give you different answer. When it comes to new machine, they have not mentioned anything on the insurance, which means it's going to be same 2%. The logic is, if nothing is mentioned on the insurance, the premium is going to be 2% of the original cost of the machine discounted by. So first year is 3 machines into 100 lakhs into 2%. 3 machines into 100 lakhs into 2%. When you are doing old machine, it is like year 4 to year 8 calculation. New machine is year 1 to year 5 calculation, and incremental insurance cost is outflow. Old machine, new machine, and whatever is the extra amount, that's our outflow. Extra machine is going to extra outflow. Extra amount is going to be outflow. Incremental insurance cost 3.84, 3.49. This will go to the main working note. This is the insurance calculation, old machine, new machine, and whatever is extra, incremental insurance cost. Incremental insurance cost. The incremental part needs to be captured and written. 3.84, 3.49, 3.17. Which number? 2.16 is 8 into 18 lakhs into 2% divided by 1.1 year 2 divided by 1.1 another 1.1. So you'll have to do 3 times divided by 1.1. Second year is first year number divided by 1.1 thereafter. 2.16 no. 6 is 300 lakhs into 2%. 300 lakhs for the new machine, 3 machines into 100 lakhs into 2%. 2% of the original cost of the machine. The line is not given in the new machine, so you take as per the old machine. This is an extra cost. Insurance is extra cost. Incremental insurance cost. Can you proceed? Okay, the next item we had is something on the utilities side. What they mentioned is there is going to be a saving in cost of utilities of 2.5. I don't know what is old machine cost, but in new machine you are going to save 2.5 lakhs. So utilities is positive 2.5 for all the 5 years. This is a savings for every year. Savings in cost of utilities 2.5 for all the 5 years. Savings in cost of utilities 2.5 for all the 5 years. 2.5 for all the 5 years. We are going to save on the utilities front. 2.5 lakh is the saving in utilities every year. Savings in cost of utilities 2.5 lakhs. Any doubts on this? Clear? Okay, depreciation again a note. Note 7, depreciation. Particulars 5 years, depreciation of old machine, depreciation of new machine. It could be incremental, it could be saving. Old machine, what is the depreciation? Read it and let me know the amount. Read it carefully and tell me the depreciation amount for old machine. Depreciation for old machine. For how many years? Yeah, it's only for 2 years. Your old machine is, you purchased it for 18 lakhs. 5 years is the life for the purpose of depreciation. 3 years already claimed. So depreciation is 18 divided by 5 years into 8 machines. 18 divided by 5 years into 8 machine. Only 2 years. 3rd, 4th, 5th, no depreciation. 18 divided by 5 into 8 machines. 18 divided by 5 into 8 machines. Depreciation only for 2 years. 3, 4, 5 no depreciation. Only 2 years depreciation. 3rd, 4th and 5th no depreciation. 18 by 5 into 8 machines. When it comes to new machine, what is the depreciation? 300? Yeah, 300 lakhs is the original cost and my salvage value is 10 lakh per machine. Salvage value is 10 lakh per machine. So 300 minus 30 divide by 5 years. 300 minus 30 divided by 5 years. Incremental depreciation, negative, it will come as negative there. Incremental depreciation. Depreciation of old machine, depreciation of new machine and extra depreciation. Old machine, new machine and incremental depreciation. Incremental depreciation. Put it in the working note. Now you can complete, you can get PBT, deduct tax, PAT, add back depreciation, all of that you can do. these will be your CFAT for 5 years. The critical part is getting these numbers. It's not that it's difficult, it is just that we'll have to do a lot of calculation. Any doubts in these CFAT numbers? Can you proceed? Next working note. Working note 3, terminal flow. Working note 3, terminal flow. Terminal flow, particulars, amount. Working note 3, terminal flow, particulars and amount. Point number 1, recapture of working capital. Recapture of working capital. Recapture of working capital. In step 1, did we write any working capital number? How much? How much? Okay, recapture is 50 lakhs. Point number 2 is net salvage value. Net salvage value. Listen, I'm not going to do a separate working note, but in net salvage value also I have to do something called as incremental. What is incremental? Is NSV of old machine, NSV of new machine, and incremental. Like every line item we did this, I have to do it here also. Listen, old machine will have a salvage value of 0. That's why I'm not doing that calculation. See, when will a salvage value be 0? 1, the sale value should be 0 and it should be fully depreciated. Old machine is fully depreciated and the sale value of the old machine after 8 years is no salvage value. When it comes to this machine, it will have a salvage value of 10 lakhs into 3. 10 lakhs into 3. Wait, this 10 lakhs into 3 is the sale value, not the salvage value. Not the net salvage value. For net salvage value, you will have to consider income tax. That you can do it in your calculator if sale value and book value is going to remain same. That is, I am going to sell the asset for 30 lakhs and book value will also be 30 lakhs. Why 30 lakhs? Because we depreciated 54 into 5. We have depreciated 54 lakhs into 5. If both are same, I directly write net salvage value is 30. Otherwise, you will have to do a calculation which is sale value less book value, capital gain, capital loss, tax paid, tax saved, and NSV. As of now, we can straight away write 30 lakhs. Any doubts in this? For total terminal flow. Total terminal flow. Total terminal flow is 80 lakhs. Consolidate and calculate NPV. That's all. That's the easiest of the lot. Consolidate and calculate NPV. Total terminal flow 80 lakhs. Last step is consolidate and calculate NPV. You will have to take the figures from the appropriate steps. Take the figures from the appropriate steps. Year 0 will come from step 1, year 1 to 5 will come from step 2, and last year is step 2 plus step 3. 276. We have done a separate working note, no? The NPV is 184 lakhs. NPV is 184 lakhs. We'll go ahead with the project as it leads to positive NPV. Last year is step 2 plus step 3. You will have to add 80 for the last year calculation. Step 2 plus step 3. It has to be step 2 plus step 3. Let me know if you're not getting any of the numbers. This step is the easiest of the lot. We are just copying numbers in this step. We are not doing any calculation per se, no new analysis. We are just copying the numbers. 184 lakhs. Can you proceed? Any doubts on this? NPV is 184 lakhs. The project is generating positive NPV and hence we go ahead with it. The project is generating positive NPV and hence we go ahead with this. Can we move? Okay, I'll move to the second question now. Let's go through the second question. A manufacturing unit engaged in the production of automobile parts is considering a proposal of purchasing one of the two plants, details of which are given below. Cost, installation, life, scrap value, output. Annual cost of two plants are as follows. Will it be advantageous to buy plant A or plant B? Substantiate our answer with the help of comparative unit cost of the plant. Interest on capital at 10%. Make other relevant assumptions. Please go through the question. Okay, they have given details of a manufacturing firm which is engaged in manufacturing of automobile parts. Now I need to buy one of the two plants, plant A or plant B. If you read this question, you will not see any items of revenues. There are only cost. If there are only cost, step 1 initial outflow, step 2 in between flow, step 3 terminal flow, consolidate and we calculate something called as present value of outflow, not NPV. It is not called as NPV because there are only outflows and we call it as present value of outflow rather than giving the name of NPV. We will do it together, the same set of steps. Let us start. Working note 1 initial outflow. Working note 1 initial outflow. Working note 1 initial outflow, particulars, plant A and plant B. Working note 1 initial outflow, particulars, plant A and plant B, plant A and plant B. Capital expenditure, working capital. Okay, one more thing. In this question, we are going to have only outflows. Listen. We are going to have only outflows. So, outflows will be written as positive, and if at all any inflow comes, I will write that as negative because we are calculating present value of outflow. So, anything which is outflow is a normal number for us. If at all I have an inflow, then that is positive. If at all, rarely you may see an inflow. What is the capital expenditure of plant A? How much? 20? No, you will have to consider installation charges also because that is also incurred on day 0. So, your capital expenditure for plant A is 24 lakhs, plant B is 40 lakhs including the installation charges. So, 24 lakhs and 40 lakhs, 24 lakhs and 40 lakhs, plant A 24 lakhs, plant B 40 lakhs, working capital is 0 and 0. Installation charges will form part of initial outflow. 24 lakhs and 40 lakhs are the initial outflows, 24 and 40. Capital expenditure 24 lakhs, working capital 0, initial outflow is 24 and 40. 24 lakhs and 40 lakhs. Working note 2 in between flows. Working note 2 in between flows. Particulars and 2 machines. Particulars and 2 machines. Working note 2 in between flows, particulars and 2 machines. Particulars and 2 machines. Okay. Now, we are going to have only cost, so we will keep capturing the cost and add everything. That is your in between outflow. Cost, installation charges and all is fine. Regular cost is, write those wages, indirect material, repairs, power, fixed cost. So, all expenses you can note down. All outflows will be positive for us. Write down those outflows: wages, indirect material, repairs, power, fixed cost. the various outflows which are given in the question: wages, indirect material, repairs, power, fixed cost. Any doubts on this? Okay, now listen. We have written these 5 numbers. Is there a tax rate given in the question? Anywhere any tax rate given in the question? Any information on taxes? Okay, listen. If they give tax, then I'll calculate depreciation. If the tax is not given, there is no point of calculating depreciation, because the purpose of depreciation is to compute tax. If tax was given, then this is not my expense. The expense would have been this into 1 minus tax rate, because there is going to be a tax saving on these items. So this into 1 minus tax rate will only be my expense. On top of that, see, what we would do is, let's assume there is a 30% tax rate. If at all there was a 30% tax rate, wait for some time, tax saving on costs, this into 0.3 if there is a 30% tax rate, and tax saving on depreciation. Depreciation also you save tax. You will calculate, put 30% of that, and then only you get the net cash flow. Then only you will get the net. All savings are inflows are negative for us. All inflows are going to be negative in the problem. As far as this question is concerned, it ends here. That's all. Total cost, no depreciation, nothing. This is the annual cost. Total outflow. Total outflow 9 lakh 60 and 12 lakh. 960 and 12 lakhs. Nine lakh 60 and 12 lakhs. Total outflow 9 lakh 60,000 and 12 lakhs. Any doubts on this? 960 and 12 lakhs. Okay, listen. I have step 3. I am not doing a separate step 3. I know the salvage value. It is some 4 lakh and 4 lakh. Let's consolidate. Okay, let's write it. Okay, working note 3, terminal flow. Let's write it anyway. Working note 3, terminal flow. Working note 3, terminal flow. For capital expenditure, we get NSV, and this is recapture of working capital. Particulars plan A, plan B, NSV and recapture of working capital. NSV and recapture of working capital. What is the salvage value they have given? 4 lakhs and 4 lakhs. It is negative 4. Okay, this is an inflow. All inflows will be negative, all outflows will be positive. NSV is negative 4 and negative 4. Net salvage value is negative 4 lakhs and negative 4 lakhs. Any doubts in this? Now you can consolidate this and calculate present value of outflow. Separately you do plant A and then plant B. Consolidation, listen for a minute. Consolidation and calculation of present value of outflow. Year 0 outflow you know. This is annuity 1 to 15 and at the end of 15th year. For annuity factor, you can take inverse of capital recovery factor. For annuity factor, you can take the inverse of capital recovery factor which is given in the question, or you do it in the calculator. Anyway, the factor is given, you will take inverse. The factor be 4 decimals. They are working with 4 decimals. Listen, if the question gives factor in 4 decimals, you do 4 decimals. If the problem is silent or they don't give you factors, then it is 3 decimal. Then only it is 3 decimals. Do it now. Next working note, calculation of calculation of present value of outflow, calculation of present value of outflow, present value of outflow year cash flow, PVF at 10% and DCF. Your inverse of capital recovery factor will give you the annuity factor. These are the outflows value. 1 crore, 5 lakh, 10,000, some up down rounding off can happen. In the other case, it's 89 lakh, 59,000. That's the outflow value. In one project, the outflow is 1 crore 5 lakh, other one 89 lakh 59,000. Yeah, any doubts? Oh, sorry, I have swapped. Yeah, sorry. This is 0.2394 and this is 0.1315. Okay. So 1 crore 30 lakhs and 1 crore 5 lakhs, sorry. The answers are 1 crore 5 lakhs and 1 crore 30 lakhs. One crore 5 lakhs and 1 crore 30 lakhs. The answer doesn't end here. First, let me know if you have doubts on this. It is same. You will have to do those 4 steps. You will get to the answer. Initial outflow, in between flow, terminal flow, consolidate, calculate NPV. That's the rule. Initial outflow, in between flow, terminal flow, consolidate and calculate. Here we calculate present value of outflow. We call it as present value of outflow. Present value of outflow. One crore 5 lakh and 1 crore 30 lakh. Clear? Can we proceed? Okay, now listen. I cannot make my decision only looking at these two numbers. Plant A has a life of how many years? 20 years. Plant B has a life of 15 years. So, to make them comparable, we calculate something called as equated annual cost. You could have learned this at IPCC level. We calculate something called as equated annual cost. The life of the two projects is different. One project is 20-year life, another project is 15 years life. Next, working note 5. Decision making, particulars, plant A, plant B, particulars plant A, plant B, particulars plant A, plant B, plant A, plant B, present value of outflow, present value of outflow, present value of outflow, present value of outflow 1 crore 5 lakh 10,736, 1 crore 30 lakh 29,760. Present value of outflow, life was the life of plant A and plant B? 20 years and 15 years. To calculate EAC, we divide by present value annuity factor. I was explaining this when we did that earlier problem on that highway. We divide by annuity factor or we multiply with capital recovery factor. Now, annuity factor for 20 years was 8.5106 and 15 years is 7.6046. Annuity factor for 20 years and 15 years, 20 years and 15 years. Once you divide this, that is the every year cost. The cost for a single year is this number, 12 lakhs and 17 lakhs. That's the cost you incur for a single year, 12 lakhs and 17 lakhs. Cost for a single year is 12 lakhs and 17 lakhs. 1235 and 1713. 1235017 and 1713405. EAC equated annual cost 12,35,017 and 17,13,405. Clear? Equated annual cost 12,35,017, 17,13,405. Now listen, in a normal problem it ends here. I would say go ahead with machine A as it has lower equated annual cost. The problem will end at this stage in a normal question. Any doubts till this? Now in this problem they are saying substantiate our answer with the help of comparative unit cost. What is unit cost is? Both are working for 2500 hours, but one produces 200 units, another produces 400 units. So I don't end here, I am going to write production per year and cost per unit. Production per year, and then finally we will get cost per unit. We will calculate that cost per unit and then decide the machine. This production per year and cost per unit is only specific to this question, otherwise normally this will not come. Production per year and cost per unit will not come in a normal question. Production per year and cost per unit is an extra addition in this question. Production per year and cost per unit. Production per year and cost per unit. Production per year is 2500 hours into 200 units into 60 minutes. 2500 hours into 200 units per minute into 60 minutes. 2500 into 60 into 200. This can be some 4-5 decimals. I think it will be a very small number. Maybe we work with 5 decimals. 4 paise and 2 paise are the numbers finally. 0.04117, 0.02856. Cost per unit is an insignificant number. 0.04117 and 0.02856. 04117 and 02856. That's the cost per unit figure. 04117 and 02856. Zero 4117 and 02856. And then we can finally say that the company should go ahead with plant B as the unit cost is lower for the same. We will finally decide to go with plant B. Normal decision will end at EAC level. This question they have specifically mentioned calculate unit cost. Question specific requirement is to calculate unit cost. So if we go by cost per unit number, plant B has a lower cost per unit as compared to plant A. And finally, we will conclude that the company should go ahead with plant B as it has lower cost per unit. Company should go ahead with plant B as it has lower cost per unit. Sure. As it has lower cost per unit. Any doubts on this? Any doubts on this part? Okay. Let's move to question 3. Go through this question. We'll complete question 3. இந்த இது இருக்குல்ல நான் பார்க்குறேன் மோஸ்ட்லி எல்லாம் keep. Okay, coming to this question, ABC Limited is forced to choose between two machines A and B, designed differently, identical capacity, same job. Machine A cost 150, 3 years. Machine B cost 1 lakh, 2 years. Ignore tax. Which machine Reliance Limited, which machine ABC Limited should buy? It's technically ABC Limited should buy. Okay, now as far as this question is concerned, I do not see any inflows. So we are going to straight away calculate present value of outflow. If life is same, lower present value of outflow. If life is different, calculate EAC. We will calculate equated annual cost and then make the final decision. So we are going to first start with, and no 3 steps and all, because I can straight away directly write these numbers. The figures are more or less readily available. Working note 1, calculation of present value of outflow. Calculation of present value of outflow. Calculation of present value of outflow. Present value of outflow. Machine A, 4 columns, year, cash flow, PVF and DCF. Year, cash flow, PVF, DCF. Year, cash flow, PVF, DCF. Cash flow, PVF, DCF. You can look at the numbers and then write it. You will calculate the present value of outflow. Present value of outflow. First machine 249440, second machine 204 100, 249 440 and 204 100. That's the present value of outflow. 249 440 and 204 100, present value of outflow. Working note 2, the life is not same, so I'll have to make the decision. To make the decision, calculation of EAC, calculation of equated annual cost, calculation of equated annual cost. Calculation of equated annual cost. The present value of outflow were 249 440, 204 100. Life is 3 years, 2 years. 3-year factor was 2.486 and 1.735, and based on this we'll finally select plant A. Plant A has higher present value of outflow but still gets selected. Plant A has higher present value of outflow, but still we end up selecting plant A. The reason for that is it has lower equated annual cost. The life of plant A is 3 years. So for 3 years we indirectly spend 249 440. Another plant for 2 years we spend 2,04,100. So we end up selecting plant A. With that I'll end the session. I'll continue with the balance problem in the next class. I'll let you know in the group when the next class will be.